So welcome to the first full trading week of 2013. We'll start this week by just taking a look at the week ahead. It's going to be a sort of gentle start to the new year, but we have, as of Monday, had the first of the trading reports from the food retailers, starting off with Morrison. Morrison genuinely perceived to be the weakest trading performance of any of the big major retailers, and that has been confirmed with like-for-like sales down about 2.5% over the 6-week period to December 30th, and they do look like they've been left well behind the curve when it comes to developing their multi-channel sourcing. More online buying over the Christmas period, probably at a faster rate than has been anticipated, has left Morrison looking a little bit weak in that area, and will have to accelerate spending on the online side to catch up with some of the rivals. And it's some of the rivals that will also be reporting this week. On Wednesday we'll hear from Sainsbury, and on Thursday, Tesco being one of our covered stocks. And I think the general perception is that both those organisations will have done relatively quite well. Tesco this time last year issued that very nasty profit warning, which caused a 20% drop in its share price, and really for most of 2012 their share price massively underperformed the sector. But there's been a slow and gradual recuperation going on at Tesco's, and if they have had a good Christmas, which or relatively compared to some of their other competitors in the market, then clearly there is further chance of some appreciation in Tesco's share price relative to others. The other retailer this week, and of course it is all about retailers at the moment, Marks and Spencer, shares had quite a weak start to 2013, and put it into context, the FTSE was up 3% last week, so any stock that was in reverse last week I think was a noticeable faller. Marks and Spencer generally perceived to have had a poor Christmas, particularly on ladies' clothing, and the whole confidence in the strategy of Marks and Spencer still really the main talking point at the moment. Have they got that right? We're also looking at Samsung. Samsung is one of our international recommendations that has performed very well. Indeed, over 5 years Samsung has outperformed Apple shares. It is its major rival. Obviously a smaller company, but compared to Apple, but a business that really has some huge momentum behind it at the moment. And again, research have a note out on Samsung. In terms of some of the other data points for this week, we will be looking to the Eurozone for retail and unemployment. And in terms of Thursday, it's the first chance for the central banks of both the UK and Europe to talk about interest rate policy and, of course, any further QE. And I think it's on that we'll have a quick look at what is happening in some of the other markets. And we'll start here with the UK gilt market. I think this is quite a notable start to 2013, seeing gilt yields. This is the 10-year gilt yield, which you can see the bottom here, round about 1.4% yield on 10-year gilts back in July and August. This was at the time of the heightened European worries, and that was the time when you may recall that President Draghi came up with his OMT scheme, and really since then yields have been gently moving higher in the UK, but it was a notable move last week, up from 1.8 to 2.1%. And I think this is possibly one of the main talking points of the early part of 2013. If we see a further move in UK gilt yields, it will beg the question, and particularly on Thursday in the Q&A sessions, as to what level yields will get to that may provoke the Bank of England to restart its QE programme. I'm pretty sure that they don't want to see 10-year gilt yields moving too far up at the moment, because that does in itself beg some questions about credibility of government policy on finance, and indeed question marks over its own AAA rating. I think the weekend press, for example, looking at lots of triples. It was, will we see a triple dip recession in 2013? Will we lose our AAA rating on our gilts? So that move, I think, is a notable feature, and do remember that sort of risk-free rate of return that we do see on gilts is something that does drive other markets in the fixed income side. So we'll watch that one fairly carefully. It does also mean that we are starting to see a little bit of weakness coming into the sterling. Now I think that will be more welcomed by the Bank of England. There were some concerns that we were starting to nudge 162, 163 against the dollar at the moment, and given the trading relationship we have with the US, we wouldn't want to see that sort of moving too far higher on the basis of competitiveness. So some weakness coming into sterling, which has helped. And all of that, as I say, coming back into equities, the big talking point was, if we are seeing these move in bonds and gilts, which is obviously lowering prices, hiring yields. Is there a switch going on back into the equity market? The FTSE, along with other major stock markets, had a good start to 2013, jumping by 3%, cleanly through 6,000, indeed nudging 6,100 at its peak. So really some good momentum building in the FTSE 100. I don't want to lose particular sight of some of the other international markets in all of this, and I continue to think that we should watch the appreciation of dollar versus the yen. This really sort of dates back to the change of leadership in Japan, and it feels to me like Japan has made the first big break towards focusing on currency and driving down the value of currency. We've seen a 15% depreciation in the Japanese yen versus US dollar during the course of 2012, and that momentum continues. That is making certainly Japanese exporters more competitive. That you're certainly seeing in the Nikkei, that moves swiftly through 10,000, currently trades at 10,600. Now Japan has got a sort of its own way here at the moment, but one wonders whether 2013 we are going to see others who are going to work a little bit harder on some currency devaluation at the moment. So it begs the question what Mervyn King was saying towards the end of 2012, whether he worries about some of the currency wars that could build during that period. So I think currency will remain an active market. Finally, just if we have a quick look at some of the other stocks, other currencies, sterling I mentioned against the dollar, back down to 160. If we look at some of the equities to focus on for this period, I mentioned Samsung. This is the share price chart. You can see the good relative strength that we've seen in Samsung. And finally, if we look here at the Tesco equity price there, sort of nudging that sort of recent sort of high of around 352 at the moment. Finally, just a quick look at some of the European yields. This is the 10-year Spanish yields, down to about 5% at the moment, so that continues to trade quite well. We will see some further Spanish auctions coming up in the early part of this year. And finally, this is a quick look at the euro-dollar. Bit of weakness coming into euro-dollar. I see this as more dollar strength. The dollar certainly has been strengthening against sterling, yen, which we talked about. Certainly is continuing to strengthen against the euro at the moment, so just nudging the 130 level.